Schroders has been working with defined contribution plans around the world for many years, and we realised that some of the issues that they were facing are actually global issues. So this led us to write a paper, Lessons in DC from Around the World, and we found that some of those lessons can actually be used in the UK defined contribution market.
My name's Steve Bowles and I'm Head of Defined Contribution for Schroders in the UK. Well, in the UK it's all about default design and in our opinion it's about trying to deliver real returns to defined contribution investors. So from an asset management perspective, we're trying to combine a range of different tools and concepts together to deliver solutions which will deliver those real returns to defined contribution members. Well, the chart's showing some of those specific tools that we're bringing to bear in this space. So at the very core of most of our solutions, we're looking at providing global equities as the real growth engine, but then supplementing those with different kinds of diversifying assets, as well as applying active asset allocation to that. In addition, more recently, what we're trying to do is add risk management techniques to those types of solutions to further manage the downside for DC members.
Our global research has shown all around the world actually that DC members do very little with their investments throughout their whole lifetime. And so because of that, it's really important that the default fund that they're put into is right for them.
Our analysis shows that investment matters far more as the member progresses through their investment lifetime, and the chart here is really evidencing that. So if we look at the chart, we can see that if we compare contributions and investment returns in the first 20 years, both deliver a sort of similar outcome for the member. But as we progress into that second 20-year period, then investment returns start to dominate, and that's simply because the members accumulated a large pot of money. So what we're seeing here is that if we're going to focus on investment as a driver of returns, then we want to be focusing on those later years as far as the DC member's concerned.
Our global research has shown that DC plans do very little about managing volatility. DB plans do a lot about managing volatility and consider the liabilities, but in DC plans, very few of them look at the losses that a member might suffer, particularly as they get close to retirement.
The chart here is looking at a positive outcome, but actually the potential exists for negative investment returns. So what we're trying to do here in an investment context is deliver solutions that are delivering growth, but also much more focused on managing the downside. And the concept that we've introduced into the DC market here is this concept of stable growth. So delivering investment solutions that are growth orientated, but have a much greater focus on managing the downside than perhaps existing solutions have had.
In DC, what we found is that the UK and Australia are very well diversified in their defined contribution plans. But outside of those two countries, even in the US, which is a very sophisticated DC market, we actually find that diversification isn't embraced in DC as well as it should be.
I think the first question that we need to answer as asset managers is, are these types of solutions delivering a real benefit to defined contribution members? And that's really what this chart is trying to demonstrate, that we believe, and the analysis that we've undertaken is that there is real benefits to members from adopting a diversified approach. And here in this chart we're looking at the probability of members experience a significant downside event. And we can see, based on our analysis, that members suffer a significantly reduced probability of that when they invest through a diversified approach than when they invest through a pure global equity approach. So I think we need to deal with that issue. The next issue then is, can we be doing more from an industry perspective? And I think the answer is yes. I think we see good use of these types of solutions amongst the largest schemes, and I would include Nest in that. But amongst medium and smaller size schemes, then there's much less use of these types of approaches, and still probably a majority using a pure global equity approach. Yeah, I think the first thing is that we've identified that real returns are critical in delivering DC member outcomes, and many of the solutions that we've been implementing are focusing on delivering those real returns. The second is that downside protection is critically important, especially as the member progresses through their investment lifetime. And again, at Schroders, we've introduced the concept of stable growth, about delivering growth but in a much more risk-constrained way. And again, that's one of the pivotal factors in terms of our product design process that we're going through at the moment. The third is that we fundamentally believe that diversification is a key tool in delivering these types of solutions. And again, it features in almost every single defined contribution default solution that we've been designing over the past couple of years.